non-current assets and depreciation. In this lesson, we'll look at capital expenditure. Capital expenditure concerns firms buying assets that they intend to use as part of their long-term operations rather than to trade. These assets are classified as non-current assets and may include property, plant and equipment and intangible assets such as computer software and licenses. Almost all assets do wear out with usage over time, and we will look at depreciation, the process whereby the cost of assets being used up are recognized in the financial statements and matched against benefits obtained. You will learn that two major types of depreciation are allowed under IFRS, straight line and reducing balance, and how to calculate depreciation charges that will be taken through the income statement and their effect on asset valuations in the statement of financial position. We will look at how the timing of the recognition of these costs is affected by management estimates and choices, and how depreciation can be used to manipulate reported profits. Session aims. In this session, you will learn about the difference between capital and revenue expenditure, the concept of depreciation and depreciation methods. And as usual, detailed list of intended learning outcomes from this lesson. Capital expenditure. In broad terms, we can define capital expenditure as being investments made by firms in the expectation that these investments will generate future revenues and hence give firms a return on their investment. These investments may be in property, plant and equipment, so buildings, planes, trucks, machinery and specialist equipment, here's an oil refinery, or in intangible assets such as software, patents and licenses. In a more formal sense, we can define capital expenditure as investments made in assets the firm intends to keep for more than 12 months. In other words, non-current assets. And these may include some things that are necessary for the firm to operate, such as the head office and data centers. And these sorts of assets do not necessarily generate revenues. But most of these investments are in productive facilities, in factories, equipment, trucks, IT, patents, licenses. All of these are assets that are needed to produce and deliver whatever products or services it is that a firm is trying to sell. Revenue expenditure concerns expenditure Revenue expenditure concerns expenditure on things and services that a firm intends to either trade or turn into goods that can be sold within the next 12 months or consumed to keep the business running. So costs related to production of goods or services to be sold, so direct costs, raw materials, direct labour costs, energy costs, cost of running manufacturing, logistics and selling facilities, and also indirect costs such as supervisory, factory and sales management, the cost of the factory itself. And then we've got money that is spent on running the business. This is non-productive expenditure. Operating the head office are utility costs, electricity, water, rent, property taxes, and consumable items such as stationery and other office supplies. And this includes personnel costs relating to the head office functions and executive management. This revenue expenditure is either expensed immediately, so taken through the income statement as an expense, or if it's taken across as an asset, as a current asset on the statement of financial position. So just to recap, one of the main principal goals of financial accounting is to produce a meaningful period figure for profit. And in order to do so, we need to match the costs associated with revenues should be recognized in the same periods in which the revenues that they help to generate are earned. So we match revenues against costs to produce a meaningful value for gross profit. Almost all non-current assets, whereas eventually need to be replaced, the exception being freehold land. And here are some examples of actual life of various non-current assets. So nuclear power station, 40 to 60 years, so a very long-lived asset. Office buildings and factory, typically 40 to 50 years. Places like Hong Kong may actually be less. Commercial aircraft, typically 20 to 30 years. Patents between 17 and 20 years. Plant and equipment between 5 and 10. Trucks and earth-moving equipment 5 to 8 years, and automobiles 3 to 5 years. Computers and software, typically 3 to 5 years life. Let's revisit the accrual or matching principle. So under the accrual principle, the effective cost of owning a non-current asset should be matched against a period in which the firm derives an economic benefit from it. And depreciation is the name given to this matching process. And we've already looked at accumulated depreciation. This is a measure of how much of an asset has been used up. The depreciation process itself has to incorporate two principal factors. The first is the capital cost of ownership, how much it will cost us to own the asset. So for that, we will need how much the asset cost in the first place, the acquisition cost, which we can get directly, and the second is an estimate, it's residual value, what it will be worth when the firm disposes of the asset. And what we also need to know is how long the firm has use of the asset for, and this will be an estimate. And lastly, the pattern of benefits that will be earned from the asset. Are the benefits evenly spread out? Are they primarily at the beginning of the life of the asset, and do they tail off? There are two different methods: straight line and reducing balance. Running costs and maintenance are taken as expenses at the time, and they're not included in the depreciation process itself. So depreciation process for matching costs of using non-current assets to the benefits from using them. Two methods: straight line, reducing balance, and we will have a depreciation charge. This is a charge taken through the income statement, which will allow us to match the use of the non-current assets against the benefits. And secondly, the accumulated depreciation, which is an item within the statement of financial position, which reports on how much of a non-current asset has been used up. So let's start off with the more common of the two methods, straight line depreciation. So this is used largely when when the benefits from using the asset are uniform over its life. So we need to arrive at two accounting estimates which have to be made when the asset is acquired. So we know the purchase cost. The first item that we need to factor that we need to estimate is the residual value, what it will be worth when the firm disposes of the asset. This will be an estimate, and it will either be an estimate of the scrap value or the resale value. And the second is how long the firm will derive an economic benefit from this asset. And this is called the useful economic life of the asset, and is measured in years. And these estimates are usually made by asset class, for example, different types of property, for PCs, for automobiles, rather than for individual assets. So let's go through the calculation of the annual charge and look at how that is used to arrive at the net book value, which is the value which will actually be reported on the statement of financial position. So first thing to do is calculate the depreciable amount. This is the capital cost of ownership over its life. And then the second is to calculate the annual depreciation charge. And we do this by dividing the depreciable amount by the number of years of its estimated useful economic life. And lastly, the net book value of the asset at the end of the year is given by the net book value at the start of the year, less the annual depreciation charge taken through the income statement. And of course, the gross number, the purchase cost, which is reported in the notes to the accounts, remains unchanged through the depreciation process. So let's look at an example. Let's look at some equation. So let's look at an example to see how this works in practice. So, piece of equipment, purchase cost $110,000, useful economic life 4 years, and estimated residual or scrap value is $30,000. So we'll start off with the depreciable amount. So the depreciable amount, the capital cost of ownership, $110,000 less the residual value of $30,000, so is $80,000. So capital cost of ownership, $80,000, and the annual depreciation charge is the depreciable amount divided by useful economic life, so 80,000 divided by 4, the annual charge is $20,000 a year. And let's now apply this. So now we have the charge. Let's look at how this affects the values of the equipment in the statement of financial position. So the value at the time of purchase, the purchase cost $110,000, and that's the value that will appear in the statement of financial position. At the end of the first year, we will have taken a depreciation charge through the income statement of $20,000, and that will have reduced the carrying value for the piece of equipment on the balance sheet from 110,000 to 90,000. And in the second year, the start value at the value at the start of the second year would be $90,000. Annual depreciation charge in the second year is unchanged, $20,000. The net book value at the end of the second year is $70,000, and that is the start value for year 3, less the depreciation charge of $20,000. Net book value at the end of year 3 is $50,000, and for year 4, we have a further $20,000 in depreciation, and the net book value on the statement of financial is now $30,000, which is the value that we estimated for residual value. This equipment will remain in the statement of financial position until it is sold or otherwise disposed of. It will no longer be subject to further depreciation charges, although it will be tested for impairment to ensure that its value remains at the estimated $30,000 residual value. So let's look at this graphically. So purchase cost $110,000, and this is the value that we reported both in the notes and in the statement of financial position. And in the first year, we have $20,000 of depreciation, reflecting the using up of the asset being matched against the benefits. Net book value is now $90,000. Year 2, further $20,000 is taken. Net book value is $70,000. Year 3, another $20,000. Net book value is $50,000. And in the final year of ownership, the final $20,000 in depreciation taken. Net book value is $30,000. And in the notes, we will see the purchase cost of $110,000, accumulated depreciation of $80,000, net book value of $30,000. And here's an example of disclosure for Morrison. So property, plant and equipment stated it cost less accumulated depreciation and any accumulated impairment losses. And costs include directly attributable costs, so that's the acquisition cost of the assets. And they have annual reviews of estimated useful life of the assets and material residual values. And they tell us that depreciation rates are used to write off cost less residual value on a straight line basis. So the method we just looked at, and then they give us estimates for useful economic life. So freehold land, 0%, it's not depreciated. Freehold buildings, they give us 2.5%. Morrison, as is the case with many companies, expresses useful economic life as percentages of the asset that will be depreciated each year. For example, for an asset with a useful economic life of 5 years, this would be 20%. Morrison depreciates its freehold buildings at a rate of 2.5%, and this is equivalent to a useful economic life of 40 years. Leasehold land over the lease period itself, leasehold buildings over the shorter of lease period and 2.5%, so the shorter of the lease period and 40 years. Plant equipment, fixtures and vehicles, 10% to 33%, so 3 years to 10 years. And assets under construction are not depreciated. Let's look at the second method in use, reducing balance depreciation, sometimes referred to as declining balance. And this is used when the benefits from the assets are expected to be front-loaded. They're going to be at the start of the ownership of the assets and tail off as the life of the asset passes. And for this, we need to determine two accounting estimates at the time that the asset is acquired. We still need to work out or estimate the capital cost of ownership. So for that, we need its purchase cost, and we also need to estimate its residual value, what it would be worth when the firm disposes of the asset. So either the scrap or the resale value. And the second accounting estimate that we need is a depreciation rate. This is a decision on how much of the asset's net book value, so this is net book value rather than gross value, is to be depreciated each year. So let's look at the calculation of the annual charge and the net book value. So the first thing we need to do is to work out the annual depreciation charge by multiplying the net book value at the start of the year by the depreciation rate. The net book value of the asset at the end of the year is then given by the net book value at the start of the year less the depreciation charge. And as is the case for straight line, of course, the gross number, the purchase cost reported in the notes, remains unchanged. And graphically, net book value at start of day one, $110,000, which is the purchase cost. At the end of year one, we have a depreciation charge of $40,000 compared to the $20,000 under straight line. Net book value is fallen to $70,000. In year two, depreciation charges fall sharply to $20,000, which happens to be the same as the value under straight line. Net book value of $50,000. At year three, the depreciation charge is now fallen to $10,000, which is half that under straight line. Net book value is $40,000. Year four, depreciation charge is $5,000. Net book value is $35,000. Under straight lines, it's $30,000. And if the firm continues to hold the asset, it will continue to depreciate. But if we stop there, at the end of year four, we'll have accumulated depreciation of $75,000, net book value of $35,000. The purchase cost value of $10,000 reported in the notes will remain unchanged. Let's just review straight line versus reducing balance. So compared with reducing balance, this is for a single asset. The straight line method results in lower charges in the early years, higher charges in later years, higher current period profit in the early years, lower in the later years, and higher balance sheet asset values in the early years. The lower depreciation charge leads to a higher asset value. And this will also be the case for a firm that continues to grow. Depreciation is one of those areas where there is scope for management to use to manipulate earnings. Switching policies from reducing balance to straight line is not actually a viable means of earnings manipulation. Any such change would have to be justified, it would have to be reported in the notes, and there would have to be a disclosure on the effects of the change. So in practice, this is not a viable means of earnings manipulation. Manipulating depreciation accounting estimates is, however, a viable method, both for legitimate earnings manipulation and also for accounting fraud. Let's start off with legitimate earnings manipulation. So if a firm wants to increase profits and asset values, what it will do is it will do two things. It will look to increase the estimates for economic life for its non-current assets to the maximum of what might be regarded as reasonable. If you think about an external auditor, an external auditor only has to judge whether estimates are reasonable, and there's a range of what might be regarded as reasonable. And secondly, to increase the estimates of the residual value, the scrap value, the resale value of these assets to the maximum of what might be regarded as reasonable. A firm looking to commit accounting fraud would go beyond what's regarded as reasonable for both of these estimates. The long life of non-current assets means that it may be several years before inflated estimates for useful economic life and residual value become apparent. and this would only become apparent if a firm starts reporting disposal losses, as it has to dispose of equipment which is not being fully depreciated as a loss. Capitalisation of interest for construction projects. Completely new topic. Under IFRS, firms are permitted to capitalise interest expense on financing for construction projects. By capitalise, what that means is that the interest expense will be reflected in the statement of financial condition rather than being expensed through the income statement. The financing must be project specific, and capitalisation of interest ceases once the project is considered operational. So once the project is considered operational, any financing which is specific to the project now needs to be recognised through the income statement as interest expense. Let's see some of the implications of this accounting. I'm going to take two companies, one of whom expenses interest during the construction phase, one of which capitalises the interest. And I'm going to assume that the asset that is being constructed is the same in both cases. So that they're both constructing a building, useful economic life of 20 years, and the total construction cost, so material, labour, other costs, is 2,000 million. So the value on the balance sheet at the end of the construction phase will be 2,000 million pounds. And I'm going to assume that this is being financed with a loan to the same value, which is being used to fund construction of the building. And let's assume that on this loan during the construction phase, that 100 million pounds of interest is charged by the lenders. If it is expense interest, that 100 million pounds will be taken through the income statement during construction, lowering profits as a result. And if we look at the operational phase, the annual depreciation charge for the building will be the depreciable amount. Let's assume it has zero residual value, 2,000 million divided by useful economic life is 20. The depreciation charge will be 50 million pounds. And now we'll look at company B, which capitalises interest during the construction phase. Same asset, so construction costs, material and labour of 2,000 million. The same loan of 2,000 million being used to fund construction, but now rather than expensing this interest, we're going to capitalise it. And that means that the value of the building on the balance sheet will not be 2,000, but it will be 2,100 million. That extra 100 million from the capitalisation of interest, increasing the book value of the building. So the value on the balance sheet, 2,100. And the annual depreciation charge will now be 2,100 divided by 20 will be 55 million pounds. So what has happened is that recognition of the interest expense has been deferred from the construction phase to the operational phase. And that's what many of these accounting policies do. They don't affect the actual recognition of the expense. They affect the timing of the recognition of the expense. 100 million is still recognised, but for company A, it's recognised during the construction period, and for construction B, it's recognised during the operational phase. So in this lesson, we've looked at the difference between capital and revenue expenditure. We've explored the concept of depreciation and depreciation methods. And finally, we've looked at capitalisation of interest for construction projects.